It was here on Sydney's Martin Place where the fight against a slowing economy accelerated, and it happened here inside this building, the Reserve Bank of Australia. 3 times this year, the RBA board cut the official cash rate, ultimately hitting a record low of 0.75%. They were designed to get consumers to spend and businesses to borrow so that they could invest and create jobs. But that didn't happen, even with some government support in the form of tax relief.
So the major banks have told us that 9 out of 10 customers have not reduced repayments despite lower interest rates.
And that's because there's a degree of caution in the economy. Consumers are uncertain about their jobs, uncertain about what will happen in the economy. That's causing them to save that money.
Lower interest rates did have other consequences as investors look for higher yielding assets. They offloaded the Australian dollar but were drawn to the Australian share market, and after a correction, national property values returned to growth at the end of the year. Still, our central bank is likely to cut rates further.
We see rates going down, and we see the low point as being 0.25%, and that being achieved by March of next year. The bottom line here is the Reserve Bank has goals to achieve: full employment, higher inflation, higher wages growth. They're not meeting those goals. Ideally, they need some help from Canberra.
Our hope is that we do see some more fiscal stimulus in the May budget next year. We're hoping for another $8 to $10 billion of tax cuts. We think that might be enough to start to see consumers go out and spend a bit more.
But in the absence of that, the RBA may be forced to look at unconventional policy measures. It's already ruled out negative interest rates, but may step up forward guidance. Now, that's when the RBA clearly states that interest rates will stay low until its inflation, unemployment and growth forecasts are met. Also on the cards, quantitative easing.
And that involves the central bank using printed money to buy government bonds to pump that cash into the economy. The theory is that some of that extra cash will be lent out. It will result in lower cost of funding through the economy, potentially even lower mortgage rates, and also that printed money will put downwards pressure on the value of the Australian dollar.
It certainly worked in reducing bond yields. You see that in the US, in Europe and Japan. And in small open economies similar to Australia like Sweden, QE's been quite effective in lowering the currency and generating inflation. So in that sense it has worked. But as the RBA has pointed out, we've not really seen any of these central banks extricate themselves from QE yet.
The Reserve Bank Board takes a break in January, so the next time members will sit around the boardroom table to discuss interest rates will be on the first Tuesday of February.